Hey everyone, I'm Zack Oliva, one of the co-founders of Oliva Gibbs. We're a law firm based in Houston, Texas, and we work with oil and gas operators pretty much all over the country. And once a year, we bring in our good friend Josh Young with Bison Interest to do an oil market outlook, and he kind of tells us the secrets, the crystal ball stuff that's going to happen, and does a great presentation. For those of you who don't know Josh, he's probably the most followed man on Twitter in the oil and gas space. Additionally, he's one of my good friends, which automatically makes him awesome. And he manages and founded Bison Interests, which is a hedge fund based in Houston that primarily invests in the oil and gas industry. Josh, thanks for joining us. You've got a bunch of slides for us. So we're going to cover some really in-depth information. And you also just came back from Vienna, where you met with OPEC. Can you tell us what that was like?
Sure. Yeah, it was great. Thanks for having me back. I like how we converted your guys' main office into a podcast studio.
Mm-hmm.
Sure. So first, let's just do a very short disclaimer, especially appropriate in a law office. None of this is an offer, solicitation, or recommendation. Do your own diligence and consult an advisor on any investment decisions. So in terms of Vienna, I mean, it was really, really interesting, especially in the context of the recent oil price fall in the last week.
I have
And
a question
so,
real quick.
sure, go ahead.
So how do they invite you? Like, do you just get a phone call and they're like, this is OPEC and they leave you a voicemail, or how does that work?
I got a WhatsApp message,
Oh,
yeah, from I think, executive assistant for the Secretary General.
oh wow.
Yeah.
What is, well, I don't want to ask what it
It's
said,
okay.
but yeah.
It said, we'd like you to come out to Vienna to meet with us and on such and such date. I was actually on vacation with my wife in Mexico,
Oh wow.
and I was like 90% sure it was spam.
Uh-huh. Were there any
And
emojis?
I don't think so.
Oh, okay.
So I was actually hesitant to even open. There was an attachment associated with it,
Mm-hmm.
and so I asked them to email me, and I got an email from at opec.org, and that's when I knew it was legit.
Yeah, nice.
Yeah, I'd been on a couple of calls with them. They had coordinated a set of people to talk to them after their monthly meetings. Um, I think they were really upset about some of the media coverage that they got from a few major publications and media outlets. And
Mm.
so I think they wanted to find people either on the fund management side or on the um, oil market analyst side or media side, or some people sort of on all three, to be able to talk to get feedback in terms of how they were communicating stuff, as well as to answer questions that are sort of open questions and that they felt were getting misinterpreted in the news.
Hmm. What do you think that it was a valuable trip?
Well, honestly, I think everyone was a little surprised to meet with them and hear about how OPEC cohesion was very important to them and sort of carefully managing the oil market was important to them. And then within a couple of days, to see them bring oil back onto the market and see the oil price fall more than 10% in the last week. So I think it was a little jarring. I'm not sure that they should have told us, but I feel like there probably would have been a better way to message that.
Hmm.
Um, so I think that was sort of jarring, and I'm still sort of processing that a little
Mm-hmm.
bit. That being said, it's very, very interesting. We'll get into some of the specifics in terms of sort of what we're seeing in the oil market.
Mm-hmm.
They shared what they're seeing from a fundamental perspective. And so I think they think it makes sense to be doing what they're doing.
Mm-hmm.
And I don't believe that they're lying in terms of the numbers that they're seeing. And so I think that's an important takeaway, is that I don't think they're sort of distorting what they're seeing in the oil market. And I don't think that there's an issue of certain members cheating leading to them bringing oil back in the market in a measured manner. So I think that's good, and it sort of takes away some of the left tail potential risk, at least in my mind.
Mm-hmm.
But it's also jarring again because it's a little different from how things were communicated very recently.
Did it change your perception going there?
Did what change my
That
perception?
trip change your perception of like just meeting people face to face sometimes can build trust, you know, you see someone else's point of view.
Yeah, I mean, like I said, I think there's some left tail scenarios and some sort of stories that are being told, even about this recent move to bring oil back onto the market,
Hmm.
that I think are very unlikely considering um, what I experienced and sort of what they were saying. Like, I think they're more genuine than they're being represented.
Mm,
And
I hear you.
again, like, do I think they're doing it right? Not
Hmm.
necessarily, but I think there's a difference in between judging their approach and judging sort of their sincerity or intention or what have you. And I think that matters because I think there's this real question of, hey, are we in 2014 or 2020 again? Like, is OPEC flooding the market or not? And the financial market for oil is interpreting their decision as them flooding the market. The price is moving down rapidly. As we're talking about this, oil prices are down close to 5% on the
Uh-huh.
day. So that's not sort of what you would see in a well-managed, balanced market.
Hmm.
So I think it's important to sort of have that perspective.
Interesting. So, Josh, I'm curious, what do you want to talk about first today?
Yeah, so why don't we go through, we put together a few slides
Hmm.
to share. I was chatting with you before that we have sort of like 50 macro slides and we cut it down to way fewer. So
Hmm.
hopefully it doesn't take too long to go through
Hmm.
these specific slides. But why don't we go through the oil market and then a little on the natural gas market and then a little what we're seeing. I invest in publicly traded oil and gas companies. So just a little about sort of what that world looks like. And I think it's relevant for a lot of the folks listening, whether they're your clients
Hmm.
or my clients or various other folks active in the oil market. And then let's go through, I think there's a number of questions that we gathered to be able
Yeah,
to go through.
definitely. Yeah, for sure. Let's start.
Great. So I think the big story is that shale has grown quite a bit for the past decade, 15 years or so. The majority of oil production growth globally has come from the US, from unconventional oil. And so mostly West Texas, Southeast New Mexico, as well as North Dakota and so on. And so I think the slowdown in shale production growth is maybe the biggest story in the global oil market. And I think that's sort of if there's one takeaway from this, it's that shale grew a lot and is growing a lot less now, and that should lead to a tighter oil market, more transactions, more leasing activity in new plays, and ultimately likely much higher oil prices. So you can see the numbers on that on this chart on the left, where you can see U.S. and global oil and liquids production and how U.S. supply grew way more than the rest of the world. Frankly, the rest of the world is actually down slightly. And that looks like, hey, maybe this will continue. But when you look at the chart in the middle, I really like this one from Raymond James. It shows oil well productivity on a per foot basis down quite a bit over the
Wow.
last few years. Yeah. Yeah, it's not the story that you hear.
Right.
And again, that's sort of, it's like, you go meet with OPEC and hear about, hey, we have cohesion, we feel in control, and we're going to very slightly adjust how we manage the oil market. And then you hear the public companies talk about, hey, we have the biggest wells ever. And then when you look at the actual data, the data is a little different on the shale side. And the more this productivity slows down, the more control the OPECs of the world have on the oil market, and the more likely it is that you end up in a scenario where they lose control, not because they're producing too much, but because they're producing too little. And that growth that we see on that left chart just isn't there to repeat absent much higher oil prices. And so I think
Hmm.
eventually we're going to get there. And even using the EIA numbers, which I think are way too high, if you look at this chart on the right, we're seeing US oil production growth down quite a bit from its recent highs.
So, I mean, from your point of view, Josh, what are the factors that have resulted in, it looks to me like, less efficient drilling operations?
So the drilling operations themselves, the number of days to drill these wells is actually down,
Hmm.
but the amount of oil produced per foot
Hmm.
is down. So companies are drilling longer laterals
Hmm.
and they're drilling them faster,
Hmm.
but they're getting less oil out of them.
Mm.
So you can see how eventually this results in physical limits in terms of how
Hmm.
far you can go in terms of laterals, whether it's lease constraints, which is great for you guys from a legal work perspective, or whether it's mechanical constraints or risks to production getting interrupted. As you get longer laterals, you get more of a risk of a production disruption, more sort of things can go wrong. And then as you drill faster, that also introduces additional risk of problems as you drill or problems as you complete. And so as we get towards that physical limit, we're seeing production growth slow a lot. And with this sort of thing, often you need to see it slow before you see it stop and then shrink. And this is sort of the normal historic path that oil fields have taken and oil sort of provinces have taken over the 150 years that oil has been developed commercially. So these are the signs that you would see in the process of fields peaking.
Has this data or this, I guess, point of view made it to consideration for deals that are transacting? Like, are folks pricing this information in, I guess, from your point of view?
Absolutely. I mean, you look at the deals on assets that are widely known to be high quality, whether it's Oxy's Crown Rock deal, which was phenomenal. They got great assets, but they paid a fairly high price, or Diamondback's recent acquisition of Double Eagle, which was astonishing, both in terms of the high valuation, but also, I mean, truly impressive team and the quality of rock they were able to assemble so quickly in a very tight market.
Right.
But it looks like they sold for more than $10 million a location.
Wow.
Based on the presentation that was given around the transaction. So, and then there's like a little bit of value to attribute to various other things. Maybe it would bring it down very slightly, but it's a very high value per location. And I think what that tells you is that this chart in the center is more true than many folks in the industry would like to admit, that productivity per foot is falling. And so if you can get one of these very few remaining locations that's highly productive still and hasn't been drilled yet, you're going to pay an increasing amount of money for that location.
Interesting. Thanks for sharing that.
So one of the other trends that's out there that is interesting, in addition to falling well productivity on a per foot basis, is that you have the president out there saying drill baby drill, and you have the rig count falling, not rising. And again, it's not perfect because producers are drilling more feet in less time. So there is an efficiency aspect of it, but you're not seeing that sort of rig count increase that you would need to see, especially in a falling well productivity environment, to be able to support the sort of growth that you saw historically in shale. So this is sort of the backup for that. You see the news headlines. Trump says drill baby drill. Exxon, Chevron, Shell, et cetera, cut capital expenditures. And over the last couple of years, the rig count has collapsed. You know, it's a little bit of a chart crime that y-axis goes from 650 to 450, not to zero, but it just shows the big percent change over a relatively short amount of time. And it is remarkable. We kept this one clean to not have too many lines on it. But if you look at it from an oil price perspective, higher oil prices have only sort of mitigated temporarily this decline in oil rigs. And again, this, I think, tells you that economically, it's just not compelling for these producers to ramp their activity anywhere close to the current price. It's sort of a industry signal beyond the headlines, beyond the narrative, even beyond the math. You just look at the rig count and you look at the oil price, and inflation's real, and $70 oil, or now $65 oil as we speak, is not the same as $65 oil 5 years ago, 10 years ago, et cetera. And so I think you see that with industry activity.
And Josh, I have a quick question real quick.
Sure.
So how are producers planning to grow?
So there is one producer that just announced that has operations in the US and Canada, and they repeatedly highlighted their production per share growth in their recent announcement. I think the numbers came out last night, and they did their conference call this morning. I listened to it before coming over here. And
So is that going to be like the new metric that people use?
Absolutely. If you're in a declining environment, and you're publicly traded and you trade at a low valuation, I actually think it's a lot healthier for the industry to move towards that, where it's less about top line growth
Mm-hmm.
and more about bottom line growth.
Mm-hmm.
And you look at a lot of other industries, and they're much less focused on growing for the sake of growth, and they're much more focused on their return on capital employed. And so I actually think
So
this is
that's like barrels of oil equivalent per share growth.
yeah.
Okay.
Yeah. So if you trade at a 20% free cash flow yield and you buy back 20% of your shares
Uh-huh.
and your production falls 10%, you've grown 10% per share, but you've also spent less money. So
Right.
you've
Right.
taken less risk. You get to drill more of your best locations and
Right.
fewer of the rest.
Uh-huh.
So it's sort of lower risk, higher return for your shareholders. And then industry wide, as this happens, this is where a lot of this capital discipline has come from.
Uh-huh.
And it's where there's a lot of support for higher prices.
So it sounds like you're saying that they're planning to grow with what they have and not grow through acquisition, maybe. Is that accurate or no?
Not necessarily. I think it's just this is a part of it. One of the very interesting things to see is that if you rewind 15 years, 10 years, when companies did acquisitions and shale assets, they typically would acquire an asset and then add rigs to that asset
Mm-hmm.
and add to their total rig count. What we've seen primarily across the many, many deals in the last 5 years is companies will acquire assets and they'll either add no rigs at all, so they'll cut all the rigs on those assets to zero and then maybe shift a rig or two from their existing operations over to the new assets,
Mm-hmm.
or they'll buy the asset and cut the rig count down substantially, but not cut all the rigs to zero.
Mm-hmm.
So it's not amazing so far for the drilling rig companies. It's been a very tough last couple of years
Mm-hmm.
for those drilling rig companies. But for the producers, it's been very good because it's really helped, I think, support higher margins despite falling well productivity.
Thanks.
So another trend is rising demand and falling global inventories. And again, this is not something you see in the news much, and we're sort of skipping on some of the things that people talk about all the time, but where
Mm-hmm.
there's not, I think, a whole lot to say. And I think this is something that people don't really appreciate. So that's so there's sort of two things happening. We had a third chart in here that we cut that I always love talking about, where global oil field services spend and global upstream spend is down precipitously over the last decade.
Mm-hmm.
And so what's not down is global oil demand, which
Mm-hmm.
is growing by about 1% a year,
Mm-hmm.
like it has for the last 4+ decades.
Mm-hmm.
And frankly, people in downturns always or often think, hey, is this the end of oil demand growth? And you actually see the speed of demand growth higher than 1% on the back end of downturns. So post COVID, you saw demand grow way faster than 1%. After the financial crisis, similar. And so we're in this time where demand is actually likely to grow faster, not slower. And then at the same time, we're in a time frame after the dumping of a large portion of the Strategic Petroleum Reserve. And there's different arguments for that. Russia invaded Ukraine. There were some
Mm-hmm.
risks to global oil supply. And then also there were elections and other concerns around inflation and real political pressure to reduce the cost of energy and reduce inflation. And so we're in a scenario where if you combine strategic reserves with commercial inventories, we're at very low inventory levels for the US and globally for oil and processed products like diesel and gasoline. And so we're in a weird scenario where we're seeing less spend, we're seeing continued growth, maybe even higher than the consensus is expecting, and we're in a low inventory environment, which is essentially there's less room for the market to get it wrong. So if you end up with continued declines in oil inventories, there's not that much left before you start getting into the necessary working capital. You need to have a certain amount of oil in a pipeline, a certain amount of oil in a silo
Mm-hmm.
to be able to have it function, and we're getting pretty close to the bottom of the tanks of those.
Have you looked into, Josh, and I don't think that these graphs maybe go out that far, but I have been reading more about declining birth rates, around the world. And so, I mean, to me, that's like a 25-year thing, problem. So, uh, do you have any opinions or a point of view to share on how that would affect uh, demand moving forward?
Yeah, so we didn't show this here, but OECD demand, so Western, US, Canada, Europe, is actually falling very slightly.
Hmm.
Actually, US demand is up year over year right now, but the trend has been for Western country demand to stay flat or fall slightly on a per capita basis and on a headline basis. And for non-OECD countries, which are seeing growing populations,
Hmm.
to grow their oil demand both on a per capita basis and on a total basis. So the global population is actually still growing quite a bit.
Hmm.
It's just growing in different places. And
Hmm.
so while it would be better for oil if the US population was growing, for example, because we use something like 20 barrels of oil per person per year
Hmm.
versus sub-Saharan Africa maybe using 2 barrels per
Hmm.
person per year, that's still 2 barrels per person as you go from 8 billion people to potentially 10 billion people over the next 20 or 30 years. So yeah, the Western population is declining, or staying flat. The global population is growing. It's growing in sort of the global south. And then depending on sort of which politician you listen to, it's either a good thing or bad thing that
Hmm.
some of those people are moving here and moving to the Western Europe and Canada and so on. And depending on those trends, we could see higher or lower oil demand growth. Um, but we're not yet at peak population. It's still growing quite a bit.
How much do you think you use per day?
Me personally,
Yes.
I don't know. I haven't done that calculation.
What's your best guess?
So my commute's quite short,
Right.
and so I do drive my kids to school. I don't know. I think I'm probably right in there in the average. I think there's a few people that don't use almost any oil, and then there's
Right.
people that use a ton. They drive their truck like 60 miles a day for work, and
Uh-huh.
I'm probably somewhere in the middle there. What do you
Is the
think?
middle one? Like 1 barrel of oil a day?
No, no, no. It's 20 barrels of oil a year per person.
Oh, okay.
Yeah.
I don't know what I use. I love filling up my car though. Every time I'm doing, I'm like just pumping money into the economy, baby.
See,
And
that's
it's
a
so much faster. Like if you have like a Tesla, and I have a lot of friends that have Teslas, and they're pretty cool, right? I don't get the same feeling. Like I've been with them when they're charging their Tesla, and I just don't get that same feeling. Have you noticed this?
yeah.
Also takes longer.
It takes forever.
Yeah.
Even the like supposed superchargers or whatever. And
Right.
then, maybe it's just that I see too much on Twitter or news
Right.
articles, but I'm always a little worried about it like catching on fire or something.
Right.
The incidence of that is unfortunately higher
Uh-huh.
than gas station fill ups catching on fire or what
Right.
have you. So, um, you know,
All right.
I'm probably biased, but yeah, it's
I'm gonna
great.
stop so we don't get flooded with a bunch of angry Tesla owners.
Yeah.
What's the next slide?
Okay, so this is going to be real contentious, and I promise it's not because I just met with OPEC. So here, let's go to the next one. So we did a lot of work on this, and I just got to meet with OPEC and see their assessment, which I think is primarily driven by energy aspects, which is um, a leading oil consultancy that does a lot of work on sort of bottom up assessments of the oil market. And I've seen various estimates for the call on OPEC for 2025, and we did an update. I think we emailed out in December showing about 260,000 barrels a day as the call on OPEC for 2025. Um, this changed a little for a few reasons. So one, the rig count is down versus consensus expectations for so far in 2025, and we're not seeing an acceleration of that activity. So they're sort of missing wells for the US, where we're likely to materially miss the forecast from the EIA. And then there's a few countries where they're forecasting oil to grow, production to grow, where we're not seeing the same production growth. So Guyana is growing a little less, Brazil is growing a lot less. There's a few other countries that are growing a lot less. And so we think that OPEC we think they actually see a little less of a call than this. And we think they see room to add for at least a few months 140,000 plus or minus barrels a day back to the market starting in April. And I think they see room to add in a seasonally strong period through the summer and then potentially to pull back or potentially to maybe start refining more, start feeding some of their own, like Kuwait's been building a 1 million barrel a day refinery and ramping that. So maybe some room to ramp for their own use or for exports of refined products, but they see room for 1 million barrels a day. This is really important, I think, right now because oil prices are falling because the EIA view is a zero call on OPEC for 2025. And again, this is where I think it's really important to have visited them very recently,
Mm-hmm.
listened to them. And I came in with a real skeptical hat on.
Mm-hmm.
Basically, I figured, hey, this is a weird move to have a bunch of fund managers and oil analysts and people active on social media to come out to Vienna to meet with them. And I think they mean it. I don't think they mean to oversupply the market by 1 million barrels a day. I think they know what that would do to the medium term price for oil. And so I think the market's sort of having almost a temper tantrum in response to OPEC adding barrels, especially in the midst of these sort of tariff concerns and other sort of economic concerns. And I think we'll get through it pretty fast. And global inventories based on satellite providers have drawn by about 80 million barrels since the start of the year.
Mm-hmm.
So that's roughly 35 plus million barrels a month, or
Mm-hmm.
close to 1 million barrels a day of an undersupply, a little over 1 million barrels a day of undersupply,
Mm-hmm.
based on what the satellite data shows. Mostly it's actually China depleting their onshore inventories. And so that shows basically this call on OPEC. So this is one of the biggest questions in the oil market, and we're bullish based on what we're seeing for oil demand as well as oil supply. And I think people are just getting this wrong right now, and I think we see much higher oil prices potentially even in a couple of months.
Mm.
So not only do I think that, but the folks in Vienna might not like this one so much, but we think that the OPEC members need much higher prices in order to balance their budgets. And it's not just that we think it, also the IMF thinks it,
Mm-hmm.
and then we can observe their fiscal situations where Saudi Arabia has actually issued billions of dollars of bonds. Various other countries are borrowing money in order to balance their budgets. They also have very large capital programs that they're looking to deploy, whether it's NEOM in Saudi Arabia or various other programs in various other countries. And so this doesn't mean that they're going to try to get to a $96 a barrel or $85 a barrel price anytime soon, but it does mean that the clock is ticking. The longer the price stays lower than these sort of fiscal break evens, the higher the oil price needs to go and the longer it needs to stay there. So when you look at their break evens, it's pretty promising. And again, it's not that this will necessarily happen tomorrow, but this is a pressure, and the longer prices stay lower than 85 or 95, the higher prices need to go for their budgets to balance. And it is important to remember that, while stimulus and staying popular is important for Western politicians because they need to get elected, most of the OPEC and OPEC plus members are dictatorships, or some have elections, but they're essentially dictatorships, and they need to keep their people happy through subsidies and through distributions and through social programs. And so if they run out of money, they're in deep, deep trouble. And so they have a non-economic, non-election driven motivation to keep prices higher over the longer term in order to stay in power.
Josh, how many more slides are there?
I think we might be it for the oil market.
Oh,
I think
okay.
this might be the last one. If not, maybe
Oh, okay,
there's a couple
cool.
more. Yeah.
I had a few questions to ask. I'll wait until you're done.
Sure. Well, this is just the, I mean, don't listen to me. Listen to, Bloomberg says it, IMF says it, whatever. This isn't like some radical research that we did digging through their budgets. It's literally just the headline price. And then when you look at OPEC's activity, they seem to be signaling, again, I don't know that they'll love this chart, but they seem to be signaling where they've extended cuts and where they've done production cuts. They seem to be signaling that they want prices higher than a certain level. And the way they've been managing the market makes it look like they actually want oil to get higher, not necessarily radically higher, but maybe closer to that $100 level. I guess that's radically higher versus today's 65 price, but not versus 2 weeks ago $75 price. And so I think there's a lot of pressure on them to do it, and I think that's a reason to think that they're not likely to go crash the market while trying to get to this sort of moderately high price.
So does it work like they do this action slowly and slowly push up the price, or is there a possibility for more aggressive moves?
I mean, I think the problem is that OPEC cuts are generally not particularly bullish
Mm-hmm.
for the price, because I don't think people talk about this enough, but we see it actually more for natural gas, which we'll get to in a second. But for natural gas, it's like very easy to think about. There's not enough storage.
Mm-hmm.
And so there's always a risk that in any given winter that you'll go from there being plenty of natural gas to actually needing the price to go high enough that it induces people to shut off their gas-powered heaters or their lights or whatever because the price is so radically high
Mm-hmm.
that the price curtails consumption. But natural gas is amazing, and so people don't want to cut it off. You may not even know if gas is $4 an MCF or $6 an MCF, and so you need it to go to 30 or 40 like it did in Europe
Mm-hmm.
in order to get regulators involved and to get the government involved and to have the news telling
Mm-hmm.
everyone, hey, slow down on your heat and so on.
Mm-hmm.
We experienced that very briefly. Actually, I think I sheltered at your house very briefly in the winter storm in 2021.
Yes, man, I forgot about that.
Yeah. So you need that, right? So
Living
that's
in
one of the
Houston, you just like
things.
have to have a generator now. It's crazy.
Yeah. Yeah. I was living in a big apartment
Yeah.
complex at the time and they just didn't have it. So that's part of the price formation for natural gas, is that risk of essentially running out. So for oil, that's also true. It's just less true when inventories are high. That's part of why it matters so much that global inventories are at or near 10-year lows. And it's part of why it matters that inventories were falling so much. I actually think OPEC might have been worried that oil prices would catapult higher, and that's part of why they were trying to bring back oil slowly. Um, but it's pretty hard for prices to move linearly and to sort of gradually increase to the price that I think they need them to be at or want them to be at when they've done a big cut and have a lot of spare
Mm-hmm.
capacity. So I think they want to show less spare capacity to allow the price to sort of settle in that high 80s, low 90s, or maybe even per the IMF, $100 or so. So I think they want to get the oil back on the market to mitigate the risk of a sort of slingshot like we saw in 2022, where prices went from 70. And so, I think they really want they want to balance the market and they want to have sort of a smooth price change. And again, I think market participants are getting this one wrong, absent there being some big factor that we're not seeing. But in the context of recent global oil inventory declines and global product inventory declines, it looks like they're sort of doing the right thing to add production back slowly.
So if we were sitting here on March 5th, 2026, and oil's at or over $100 a barrel, what would have happened over the last year to get there?
So I think the biggest factors are going to be this forecast being right on shale production growth slowing. So
Mm-hmm.
that EIA number of 500,000 or 600,000 barrels a day of growth being missed, and that number coming in a lot lower, which we're seeing with this low rig count. So
Mm-hmm.
I feel increasingly confident in that as the rig count is falling and as well productivity is falling, right? It
Mm-hmm.
just gets easier. It's sort of more in the bag as you get into the year and as the year
Mm-hmm.
progresses and as the rig count disappoints and as well productivity disappoints. I think most likely for that to happen, you'd need sanctions to be enforced on Iran or Venezuela or Russia. I think you need some amount of sanctions enforcement. It's been promised, but it is possible that Trump and various other world leaders choose to not enforce sanctions for various reasons. So I think that could that could reduce the odds of oil getting to that 100+ price. and then OPEC panicking and flooding the market was always a possibility. It's unlikely, but possible that that could send prices a lot lower or sort of keep it from that. Or actually, if they stop, if the oil market's undersupplied, but OPEC stops returning barrels to the market,
Mm-hmm.
that ironically could actually temporarily reduce the oil price. It would take speculation out of the market to some extent, I think, and it could actually sort of set the price, at least for a little while, lower. OPEC bringing production back on increases the ability for the price to rise. It doesn't remove it over more than a short period of time.
So if you were, I mean, I'll put it into the context of your profession. You are the majority shareholder of a large oil and gas, company in the United States. Knowing what you know, and from your point of view that you've shared with us, of the next 5 and 10 years, what would you be pushing management to do?
It's a great question. Here, why don't we go to the next slide? I think that might address it if we
Oh,
make
dang! I
that.
didn't even see these before.
Yeah, yeah. We changed them slightly. So I think right now we're in this period of low prices, which is depressing activity, and this is cyclical. Goldman and various other folks sort of innovated around this theory on cyclical businesses and commodities, and so I think the thing you do in a period of low prices, in addition to cutting back on your drilling activity to make sure all your capital is earning a really high rate of return,
Mm-hmm.
is if your equity is at a low valuation, you buy back stock, and if it's at a high valuation, you go and acquire assets.
Mm-hmm.
So I think those are and then under almost all circumstances, you pay off debt to some extent too,
Mm-hmm.
just because debt is one of the ways that you can actually lose and go out of business in this sort of circumstance.
And
Actually, here we can go back one. Sorry.
I, well, I won't ask which. I mean, what percentage of companies do you think are of the public companies in the U.S. are responding appropriately to this environment, from your point of view?
I think actually on the oil producer side, most of the companies are responding reasonably appropriately. I think it's less of a absolute question and more of sort of an incremental argument. I think there's room for producers to incrementally cut back on their activity.
Hmm.
I think if you're a XYZ producer at 10 rigs or 20 rigs or so on, cutting down by 10%, 20%, 5%
Mm-hmm.
versus what you were planning on doing,
Mm-hmm.
frankly, it's already happening.
Mm-hmm.
We saw budgets, we saw plans, and companies are acting on this. They are already sort of pulling back on activity.
Mm-hmm.
But I think pulling back a little more and then being a little more aggressive on acquisitions, I think is a really sort of good longer term capital allocation approach.
Mm-hmm.
And then secondarily, um, pulling back and buying back shares or paying off debt is also a good approach. And again, it's not wonderful. Frankly, I own some shares in some oil field services companies. It's not great for land law and certain other professions
Mm-hmm.
to the extent companies do that in the short term. But the flip side is it makes the industry more resilient, and it will result in a much more robust market over time and much more highly valued and more robust companies. So I think there is this tendency for commodity producers to rush to overproduce as you go from a low price environment towards a high price environment. And I think on an individual company, again, I'm not recommending any sort of coordination or anything like that. I think the optimal sort of game theoretic decision for most of these companies is to actually drill less. It extends their inventory life and then repurchase shares or buy assets depending on their specific value versus the value of assets that are available to them.
Which companies do you think are the best at allocating capital?
I think I might get myself in trouble talking about
Okay.
that. So, but I think there are some companies that are sort of well known for being great capital allocators.
Uh-huh.
And I think there's going to be a next set of companies that sort of get that mantle over the next decade or
Oh,
so.
okay.
So I think there's the companies that are known for that, and then there's the companies that will be known for that. And in many cases, they're not the same companies.
Oh, interesting. Is that like a size issue or? culture issue, or what do you think?
Yeah, I don't know. I mean, I think like let's pick on the oil majors just because that's a little they're so big. I think it's a little less contentious. You look at the shifts at BP and Shell recently where they had reallocated capital to renewables and now they're reallocating back to oil and gas. Um, I think they sort of lost the vision of their founders and they lost the vision of the things that grew them to the point where they had the capital available to allocate. And
Uh-huh.
frankly, I think they're messing up again. Those guys are shifting. They're sort of flopping from. They went from oil and gas to renewables, and now they're flipping back to oil and gas. And the reality is, if the oil and gas wasn't compelling enough for them to invest in 3 years ago, they should just be buying back shares and maintaining capital discipline. So I think that's an example of poor capital allocators maybe staying poor capital allocators.
Well, do you think that return on capital was the driving metric behind allocating to renewables, or was it like the ESG pressure?
Well, I think it was the ESG pressure, but I think if their returns were high enough,
Uh-huh.
they might have continued to invest in those activities. And so I think it's hard for them to do that.
Oh, okay. Interesting.
But again, that sort of makes it a bad decision possibly to invest in those upstream assets like they're doing again. And I think it's why activists have been attracted to those names.
And so, Josh, I'm curious, you know, we've talked about large publics, and we both have friends that are small private companies in the US, maybe even some that aren't even private equity backed. There's a lot of great small operators right now. What are their thoughts on what's going on right now?
Honestly, they ask me. I don't think they know for the most part. I'm invested in a few of those
Uh-huh.
personally, or a little bit with Bison too.
Uh-huh.
And yeah, I think the calculus for a really small oil company or gas company is very different from a large one.
Hmm.
And so
How so?
if the choice is running 0 rigs or 1 rig or participating in non-op working interest in a well versus not, it's a much more sort of binary question.
Uh-huh.
And so there's not sort of that spectrum of capital allocation that's available to some of these larger operators.
Gotcha. Okay. They need to make money.
They need to make money.
Yeah.
They might only have one AFE to fund. So they
Uh-huh.
fund that one AFE. They have to
Uh-huh.
look at the specific economics of that one.
Uh-huh.
It's just a very different calculus and a
Oh,
very
okay.
different funding setup as well.
Gotcha. And is there still, I mean, I think, 3 or 4 years ago, the first time we did this kind of annual talk, ESG was like really um, a pain in the butt for a lot of us in the oil and gas industry. And so, like, has that changed? Has that narrative shifted?
Yeah, I mean, it seems like it is shifting right now. I think it's funny, some of your competitors put out workshops and letters about how to sort of hide DEI practices or ESG practices into other departments of companies.
Hmm.
So that was fascinating to me to see. I think it's just a question. It's sort of similar to my comment on Shell and BP. I think there's some things that are really important, right? Like to judge people based on their merit and their character and
Hmm.
not based on other non-merit or characteristics. And so organizations that are biased towards these other characteristics, I think should just take this opportunity to refocus on just running efficient operations where they promote quality people rather than trying to hide some of the ESG or DEI type practices. And so I think we're shifting, but
Uh-huh.
some of it's sort of concerning where, if you need to hide it, you probably just shouldn't be doing it.
Yeah, I hear you. I guess I'll clarify. What I meant by my question was, do you still see, um, I think particularly what was surprising over the last few years was seeing how much money was being allocated to renewable projects in the space. And while you had historic, and we've talked about this before, historic underinvestment in the oil and gas industry. And so is that still happening?
Yeah, so let's get to our gas slides because I think that's really a
Oh,
good
okay.
tie-in. So just a short natural gas market overview. So natural gas is really important because it was considered a bridge fuel,
Uh-huh.
and poor capital allocation and overbuilds of solar and wind led to ironically, an increased demand for natural gas rather than a decreased demand for natural gas. And so you've gotten into this market where the demand itself, just for domestic gas, is up quite a bit, both from data centers and just from sort of poor decision making on capital allocation by overbuild for solar and wind. But then you also have this wonderful thing happening where there are these LNG export facilities that there's almost like the industrial revolution for LNG export facilities that's happened, where they've gone from big and custom to smaller and modular. And the small modular facilities, I mean, it's brilliant. You know, kudos to the Venture Global guys, kudos to Cheniere for their Corpus project. And I think we're moving towards this world where there's going to be more of a global price for gas, and a lot more U.S. gas is going to go into the international market right as there's a call on that domestically. So we see, I mean, there's been a lot of growth in gas production in the U.S. over the last decade, and there needs to be that much growth looking out over the next 10 years. But the problem is it's not growing that much anymore, and the drilling rig count is down a lot. And so we're in this sort of weird world where most people sort of know that you're going to need more gas, but you're actually not getting the activity necessary. And then there's a similar issue with well productivity, where actually gas wells are not getting much more productive. They're not in decline in the same way that the oil well productivity per foot is in decline, but we're sort of peaking to some extent. And so there's a real risk there. And then one of the places that this gas production is supposed to come from is from shale oil wells that have associated gas. And with a lower rig count on the oil side and falling well productivity on the oil side, there's a real risk to being able to adequately supply this market. And again, getting back to the ESG question, at the same time, you have this massive misallocation of capital, and it's ongoing. I mean, some of the largest private equity funds have very recently closed their largest ever funds for alternative energy and so on. And so, you know, there's sort of this internet image of someone like shoveling money into a fireplace. And so that activity has not slowed. It's actually accelerated to some extent. So you would think it would slow, but it seems like, I mean, there's different sort of reasons why that would happen, but there's not really, I think, alignment between the people whose money it is and the investment activity that's taking place.
Right. Interesting.
So LNG is the big driver here, both because we're getting good at using it, or sorry, building the facilities, as well as the global market starting to get used to us supplying it. And so it's sort of set up in this weird way where we're getting good at supplying it, like really good at supplying it, but we're not getting so good anymore at growing our domestic production. And so it's sort of a really nice setup for potentially much higher prices domestically. And it's pretty exciting that that this is happening. Again, it's sort of maybe concerning if you're sitting in Paris or Rome or Tokyo, but it's very, very exciting. It's very exciting if you're in Houston. So this is a EIA chart just showing how many projects are coming on. We think that there will be many more LNG projects that are announced and come on. There's a whole next set of these projects that already have approval, but they don't have final investment decisions that have been made. And so there's room for actually there to be another 10 plus BCF of growth, more than the projects that are on this chart on the left. And then on the right, it's the market's tightened a little bit, but European and Asian natural gas prices are still well over $10 an MCF, and so there's still a lot of room to absorb this gas. So another sort of aspect is faster build times, like we were talking about. Build times are down 50+% in the last decade, and I think we're going to see potentially these build times fall a little more, and I think we end up seeing way more export capacity by 2030 even. And so there's going to be a giant call on natural gas, and there's real questions in terms of where that gas comes from. There's plenty of pipe capacity getting built coming from West Texas and from Louisiana, and there's more I think that will come. And I think you're just going to need way more drilling activity eventually, particularly on the natural gas side. And so this is where it gets really interesting, where trying to balance out this sort of capital constrained environment for oil producers that are supposed to be producing this associated gas that there's a need for, but they've slowed down. And so where's the gas going to come from, and how high do you need the price of natural gas in the US to be able to induce some of this additional production in order to feed this enormous growth in LNG facilities?
All right, Josh, we've got 10 minutes left, and I have a few questions.
Okay, let's do it.
All right. So in January, our firm, put out an article on President Trump's national energy emergency executive order. What's your point of view on how that would affect oil prices moving forward?
So I think the Trump administration's trying to force the oil price down by any means necessary. I think it's sort of driven by a misunderstanding of the impact of the price of oil on the US economy. And we put out something in November, I think, on how the oil price is actually positively correlated with the US economy. But I think we're all sort of biased by where we come from and what we've done professionally. And so if I were coming out of a levered real estate developer seat where I owned a bunch of highly levered apartment complexes and hotels and was always borrowing money and always spending money on diesel and power generation and so on, I might think that the economy is that, and therefore I need low input prices for that. When the reality is that the economy in the US and globally is quite complex. And the US, we're actually a net exporter, a net producer of oil, not a net consumer of oil. And so I think there's sort of a weird disparity. It's been sort of disappointing because there are some very well-known and very thoughtful folks that have come in to advise the Trump administration. But this idea of a national energy emergency and trying to force oil prices down by any means necessary, I think, is quite destructive for the US economy. And I think it's likely to backfire. And that might actually be part of what OPEC is doing by bringing barrels back on, is if they bring barrels back on, they can't be pressured to bring barrels back on because they're already back. And if the barrels are back on and the price has been low for a little while, that's a really good setup for much, much higher prices.
So it could be like their policy of appeasing the Trump administration?
It could just be a different solution for balancing the market, where instead of going for $85 a barrel for a long time, maybe you accept 65 or 70 for a short time and then 120 for a long time.
So what tools does the administration have at its disposal to push prices down or to attempt to push prices down?
I mean, so far it's mostly been job owning and then promising sanctions enforcement and not actually following through on it. Again, it's sort of odd. I think there's sort of a general consensus among Americans that we'd rather that the Iranian regime that's been sponsoring terror and so on maybe has a little less money rather than a little more money. But in exchange for them getting money, maybe Trump sees it as sort of a worth it to have lower oil prices and to allow them to sell their oil and waive sanctions. So I think that's a sort of trade-off. There's other things. I mean, they'll talk a lot, basically just trying to guide the market down. And again, that can work for some time, but then it stops working. And I think they're frustrated already. They tried to tell producers to drill more, but I do think that the industry is in a very different place now than it was in 2017. And so I think, again, there's just sort of this misconception about where oil comes from and how it and how sort of the whole industry and how the economics work. And so, unfortunately, we had another administration recently that tried to talk oil prices down and tried to force prices down, and we ended up in a giant oil price spike in the middle of all of that. And again, there was a war and so on, but their policies hurt. They didn't help, and they ended up with a price that was unsustainable and quite high.
Yeah. I prefer incompetence at the federal level. I think that's good for the country. Incompetence and just some confusion, I think, is good too. Speaking of that, how do you think tariffs will affect the oil and gas industry?
I mean, tariffs seem pretty negative for the most part for the oil and gas industry. So companies are already spending a lot more money on pipe that they don't already have contracted, for example, because steel prices shot up.
Uh-huh.
There's a lot of risk that the global economy slows as tariffs are introduced, and then as they're introduced and then pulled back and then reintroduced and so on. That uncertainty, I think, is actually very dampening to global economic activity. Companies and investors, they want clarity and they want stability in tax regimes and tariff regimes and so on in order to be able to invest and to engage in business activity. So I think it's dampening for economic activity. And I think I'm not fully a globalist, but I think global economic wealth prosperity translates to domestic wealth and prosperity. So I think it's not a zero sum game, and trying to treat it too much like a zero sum game has a lot of risks of everyone losing, not just the other guys losing.
See what happens.
Yeah.
Every year when we do these, like, there's not a lot. There's some stuff that stays the same. Like we've talked before, I think about Saudi Arabia needs oil at a certain price to build their 3 mile long hotel or whatever they're doing, Nome.
hmm
And then some of the stuff has gone away. Like the big push in renewables has not gone away. I think it's from my point of view, it's softened a little bit,
hmm
and it's no longer in the headlines as much. What do you think? We have just a few minutes left. What do you think has stayed the same over the last few years?
So there's still way too little exploration and delineation activity. The world just needs more exploration for oil and more delineation of discovered fields. And so we're in this weird situation where there's twice as many barrels being produced as there are being found, or 3 times or 5 times, depending on sort of like which measure you use. And
Mm-hmm.
that's clearly unsustainable. And to the extent that we see oil demand continuing to grow, which has been, I think, a common theme in the last number of these, you're going to need more exploration. And it's sort of similar to presidential administration trying to suppress oil price. You can do it effectively, potentially, for a short period of time.
Mm-hmm.
But the longer you try to do it and the harder you try, the more likely it is to end up with sort of the opposite undesired outcome, which is
Mm-hmm.
much, much higher prices, as well as side effects or follow-on effects from that move.
So we would need more investment in the oil and gas industry.
Yeah, we need more
Yeah.
more investment longer term. We need more exploration, more of the delineation, and then also maybe a little less short term, short cycle drilling activity. Known fields that are already in production, maybe it makes sense to slow go them a little rather
Uh-huh.
than drill them as fast as possible in order to be able to extend the runway and extend the productive life of these fantastic shale fields.
Got it. So we'll end on that note. And I heard you say that it's going to take a lot more investment in the oil and gas industry. Just to remind everyone that Josh is an investor in the oil and gas industry, and his hedge fund allocates capital to that industry. This last slide is you can scan the QR code to subscribe to our law firm's monthly email, and also Josh's updates, which come out, I think, more frequently than monthly. Yours do.
Yeah, we have monthly, and then just
And then
occasionally there's
when
extra
something's like
stuff.
newsworthy, and
Yeah.
they're quite good. I mean, I know that a lot of people here at the firm and a lot of um, business colleagues subscribe to that. And so sign up, for our newsletters, everyone. Josh, thank you so much for joining us again. This was super informative for me, and it's always great to have you come by the office. So appreciate that.
Absolutely.
Anything else you want to say before we end this?
Nope. Thanks a lot for doing it. Always
Great.
great to be here.
All right. Thanks, man. Thanks everyone for joining. And I think the slides and a video replay will go out eventually by our team. So thanks everyone. Have a great day.